keynote by Harjoat Bhamra, Associate Professor of Finance of the Imperial College of London. And today's keynote is devoted to the financial markets and government economy policy. So Harjoat, would you introduce yourself briefly and tell us a bit more about your today's keynote address?
Okay, yes, so my name is Harjoat Bhamra. I'm an Associate Professor in Finance at Imperial College Business School in London. I'm also an advisor and co-founder at a fintech wealth management company called AdviceBridge. And in terms of what I'm going to talk about today, I'm going to talk about financial markets and government economic policy. Okay.
Thank you. So you may start with the screen share with your keynote address, and then it will be followed on by a Q&A session from our viewers and on our own. Thank you.
Okay, great. So I'll just try and do the screen share. Okay, how is the screen share?
Beautiful. Yeah, it's good. You can start.
Good.
Thank you.
Okay, great. So, I guess what I want to talk about is financial markets and government economic policy. Now, there was a time when you basically wouldn't really talk about this. So there was a lot less interest in the impact of government economic policies on financial markets. So I want to take you through basically, I guess, an overview about why we care about government policies and asset prices. And after I've talked about that, I'm going to talk about how it is and the how and why of how government actions can influence asset prices. Okay. And also I want to explain why governments have taken these actions. And then I want to end by talking about COVID-19 and talk a little bit about what the future may hold. So to set the scene, we need to, first of all, why am I here talking about this? Why are we actually interested in asset prices and returns? And why are we interested in how government policies may impact them? So there are many reasons why you might be interested in asset prices and the returns of their returns. One might be just from a simple wealth management perspective. You might be interested in managing money. And if you want to take a kind of a more scientific approach to wealth management, that's basically revolves around having an objective and then trying to maximize that objective based on your estimate of the distribution of excess return. So people are interested in wealth management and understanding what drives asset returns so they can manage wealth more effectively. A second reason why people are interested in asset prices is that there's a lot of evidence that there are feedback loops between the macroeconomy and asset prices. So as you would expect, the macroeconomy impacts asset prices. So what happens in the economy does feed into asset prices. But it isn't always obvious how that works. And one example of that is COVID-19, where we have seen that the US stock market has recovered very strongly since I guess, the action we saw in March. Yeah. But the real economy, we're basically still waiting to see what's going to happen to the real economy. And people are raising the question, well, why is there this disconnect between asset prices and the real economy? And I'll talk about that as well. And I also should mention the feedback. So it's natural that you would think that the macroeconomy impacts asset prices, but the link, it does not always straightforward. And when we think about asset prices, what do people use them for? They often use them to make financing and investment decisions, which in turn impacts the macroeconomy. So we have this interplay between the macroeconomy and asset prices, which is very important and not necessarily that well understood. And when it comes to government intervention, well, since the financial crisis of 2007 and 2008, and now during the current COVID-19 crisis, we've seen substantial government interventions with the aim of stabilizing the macroeconomy. Yeah. So I don't think governments are going to go out there and say, look, all central banks are going to say we're interested in doing X, Y, and Z to the stock market. Okay, they're never going to. I don't think we're a long way from their stated aim being to increase the stock market value. Okay, but they are very open and about the fact that they intervene in order to stabilize the macroeconomy. So that's both from the central bank perspective. So the central bank is basically, you can think of it as an arm of government, but the central banks in most countries are independent of government. So the governor is appointed by the government, but then he has his own independent mandate. He's given a mandate, and that mandate, for example, will involve inflation, okay, in most cases. A nice example of that is the European Central Bank. If you look on their website, they explicitly state that they need to keep inflation within a certain range. Okay. So the mandate is set politically, but once the mandate has been given, they basically implement that in a technocratic manner. Okay. Now, there's also fiscal policy, which is decided directly by the government. Okay. And we've seen that the various interventions that we've seen since the financial crisis in 2007, 2008, they've had a strong impact on asset prices, even though that's not the primary aim. Okay, so it's very important to understand that the rationale for government intervention is supposed to be focused on macroeconomic variables such as inflation, GDP, and unemployment, not on asset prices. Okay. Now, once upon a time, I would never be giving a keynote like this. Okay, not with this theme. Okay, we would not have focused on government policy as a way to understand asset prices and returns. Okay. So prior to the 2007-2008 financial crisis, the main central bank policy tool was the nominal interest rate, okay? And it was only the Bank of Japan that used unconventional monetary policies such as quantitative easing. I think sometimes people often laugh when you now refer to QE as unconventional. It's kind of the new conventional policy in a way, okay? And that just consists of basically buying government bonds, okay, in exchange for money. Okay, so all that happens with QE is that the central bank will say, okay, I'm going to buy government bonds, and how am I going to pay for them? With money. Okay, and the key decision there is, which government bonds to buy at which maturity, and oftentimes really it's the longer maturity government bonds which are being purchased. Now, during and in some cases just after the 2007-2008 financial crisis, interest rates hit zero. And we call that the zero lower bound. And economic output didn't actually return to trend. And we call that a liquidity trap. So when basically the standard monetary policy tool of lowering interest rates has been exhausted and it hasn't had the impact you've wanted, so economic growth has not returned to normal, we economists will say you're in a liquidity trap. And I want to show you a few diagrams of that. So here we have just a time series of this will be the logarithm of GDP. So this red line is basically the linearized trend. So if you look at the economy, it grows basically approximately exponentially. And if you apply the logarithmic function to the exponential function, the inverses of each other, you'll get basically a straight line. So this line here, I'm colorblind, but I think it's red. You can tell me otherwise. This is basically the trend, okay? Now, this line here, actual GDP, which I think is dark blue, you can see that with the financial crisis hitting, actual GDP was on a nice trend here, but then it went down, okay? And it has not returned to that trend, the pre-crisis trend, okay? So that's what we would mean by basically saying that economists would kind of often refer to the gap between this log linear trend and where we are as the output gap. And one of the aims of central bank policy is to basically minimize this output gap. What the central bank wants to do is bring this dark blue line back up here, okay? That's what it wants to do. And if the nominal interest rate has gone to zero, it can't use that anymore, okay? And so it resorts to what central banks have done, resort to other policies such as quantitative easing, okay? So between the financial crisis and the current COVID-19 crisis, the Federal Reserve, the ECB, the Bank of England, and other central banks have used quantitative easing to try and get output back to potential. What they've tried to do is say, look, we can't lower the interest rate anymore. Instead, we're going to purchase bonds, okay? And we hope that that will impact the output gap. I just want to focus here on what's happened in the UK. So here's the trend rate of basically growth. So that's basically the logarithmic function applied to GDP. And here's actual growth, okay? And we can see here that in the UK, implementing QE has not returned output to pre-financial crisis trend levels, okay? Now that doesn't mean QE hasn't done anything, okay? Maybe things would have been even worse without QE. Maybe we'd be somewhere down here without QE, yeah? But we don't know, okay? is that we can't run experiments on the macroeconomy. We can only resort to models. Now, what's been happening now? So with COVID-19, governments have been thinking about going beyond monetary policy and using fiscal policy to try and basically return the macroeconomy to normal. And they've been thinking about very unusual monetary policies, such as monetary financing. So the Bank of England says it's not engaged in monetary financing, but it looks like it is, okay? And negative interest rates. So some countries already have negative interest rates, and the Bank of England is seriously considering negative interest rates, okay? So basically, the idea is that, well, we had basically standard monetary policy up until the 2007-2008 crisis. Then we had quantitative easing. We also had forward guidance. I won't talk about forward guidance that much because it hasn't been deemed to be particularly effective, okay? And we had QE. And the question is, what comes next? So what other interventions are there on the table? So with monetary policy, it's hard because we've already implemented unconventional policies so much to the extent that we could even label them as the new conventional policies, okay? And market participants are trying to guess what's going to come next, whether the Bank of England will implement negative interest rates or not. And there's also fiscal policy, which is run by the Treasury, okay, which is distinct from the central bank. So the Treasury basically takes its orders from the government. The central bank doesn't do that. The central government has the government has put the central bank at arm's length from itself. It gives it a mandate, then it goes and implements its mandate without interference from politicians. The Treasury, of course, is supposed to take orders from politicians. That's very different. So political politics is much more important for fiscal policy, certainly in the short and medium run. Over the long run, governments can decide to take away this independence of central banks. So politics is not irrelevant there either. Okay. Now, one thing that's always kind of very amusing for me, when I kind of look back at these graphs, you can, okay, this is what's happened to output after the financial crisis. I'm not going to show you what's happened to the stock market because most people know what's happened to the stock market. The stock market has recovered very nicely from the financial crisis, okay? And in the US, it looks like the stock market, at least at the moment, is recovering nicely from COVID-19, okay? And so even though government policies are not aimed at the stock market and financial markets, it seems to be that they impact the stock market and financial markets more broadly very strongly, okay? We're in an interesting situation. The government policies, including in that central bank policies, are not aimed at financial markets directly. And we can think of what happens to financial markets as a side effect, but it's a pretty strong side effect. In fact, some may argue that the effects of these government interventions on financial markets are stronger than their impact on the macroeconomy. And what I want to show you is a simple, very simple framework for thinking about this. Then I want to show you some examples related to fiscal policy, monetary policy, and political cycles. Okay, so when we think about asset prices, there is a nice way of thinking about them theoretically. So you can think of a security as, that's just a claim to future cash flows. For example, if you buy some of Apple, some stock from a dividend-paying company, owning that stock gives you a right to the future dividend flows, okay? Now, for equities, these future cash flows are unknown, okay? We don't know what future dividends are going to be. We don't even know the probability distribution for those dividends. So I couldn't really, it would be hard for me to tell you, what's the probability of dividends for a particular company being within a particular range 2 years from now, okay? I could try and estimate it, and it wouldn't be easy, okay? So the probability distribution is essentially unknown or at best estimated with error. And how are prices related to these future dividend flows? They are basically the expected discounted values of future cash flows. So two things are going on, okay? When the market values these future dividends, it's discounting them, okay? Part of that discounting is just a simple impact of the time value of money. So what's worth more, $100 today or $100 in, 10 years from now? Well, $100 today is worth more if the real interest rate is positive, okay? So part of valuing future cash flows doesn't involve risk at all. It's just the time value of money. Okay. So it's natural that a financial security that gives you $100 in 10 years from now is going to be worth less than $100 just because of the time value of money. And then when I tell you, well, you might not get the $100, there's a chance of you not getting it, you might get a smaller amount, then the value of that $100 is going to basically be even smaller. And that's accounting for risk, okay? So if there's risk in the cash flows, okay, and if that risk is basically positively correlated with the aggregate economy, that will further reduce the value of the security. So two things are going on with discounting: the time value of money and the riskiness of the cash flows. And then there's another thing I'm going to mention is the uncertainty. So maybe you don't even know the probability distribution of the cash flows. Well, you're probably going to be willing to pay even less for the security then. So there are three things going on. There's the time value of money, there's uncertainty about the probabilities, and then there's the riskiness of the cash flow given a set of probabilities. So I just want to go over this again because it ought to be very intuitive and I don't want it to become overly mathematical. So there are two things: the time value of money. $100 in 10 years from now, even if you're definitely going to get it, is worth less than $100 today. Then if we say, you know, the probability of you getting the $100 is actually a half, and you might get zero, well, the security is going to be worth even less, okay? And that's the impact of risk. Then if I tell you, well, I don't even know the probability of you getting $100 or $50 or $20, then that's going to further reduce the value of this security, okay? And now I want to go a little bit deeper, which is that when people are basically thinking about valuing these future dividends or cash flows, the probabilities that they have in mind are not going to just be constant. They will change over time as they learn. Okay, if you have bad news about a company, yeah, you might revise your forecast for the dividends downwards, and that will basically reduce the stock price of the company. You might learn something about the management of the company. It might be good or positive. So as people's expectations about the future change, prices will change. And this last point is really fundamental, okay, and helps us understand why the stock market oftentimes seems to be ahead of the real economy. Because asset prices are really about expectations about the future, okay? So even though things may be bad for a company now, if I expect things to go much better in the future, the stock market, the equity price for that company will react now to that future good news, okay? So that's why that partially explains why we see what we see in the stock market today, is that some people are arguing that, well, the stock market is expecting a V-shaped recovery from COVID-19, so that's why stock market prices have recovered now in anticipation of that recovery. Of course, that doesn't mean the recovery will happen. That's just what people are expecting. And those expectations may change. So if it looks like a second wave is likely, and that will impact businesses badly, okay, before the second wave actually occurs, if you think it's going to happen, you'd expect the stock market to decline again. So that, of course, makes it very difficult to make money via these stock market movements, because you have to be very good at predicting the future, which is a very hard thing to do. So, you know, asset prices, I would argue that they're pretty hard to understand. Okay, we need to understand, you know, cash flows. We need to understand how to discount them. Okay, how risk and uncertainty come into play. Expectations. We need to know about interest rates, the time value of money. As I've mentioned, risk, uncertainty, and the updating of expectations. So that's all quite complicated. Okay, maybe the simplest thing to understand is the time value of money. And that's related to the interest rate. And who sets the nominal interest rate? The central bank. Okay, so the central bank controls part of what enters into the discounting of cash flows. Okay, so you can see then straight away why central bank policy might be important for asset prices. But there's also risk, uncertainty, and the updating of expectations. Okay, so that's the way central banks communicate their policies impacts basically risk. Okay, and also impacts people's expectations. And when it comes to fiscal policy, if we're uncertain about future taxation, we think, okay, well, before COVID-19, I had a good sense of what the government was going to do with taxation. Now I'm worried they might increase taxes. That creates basically uncertainty, and that's going to be reflected in stock market valuations as well. So just to summarize, how can government policies impact asset prices? Well, we're going to have these 5 channels. Okay, government policy can impact the future cash flows that a company basically earns, and then the dividends that it pays out. Okay, central banks can control the short-term interest rate. Okay, via things like QE, they can control longer-term interest rates. There's an interest rate channel that's important. There's a risk channel. Okay, and the risk channel is very general. That can relate to political uncertainty. We're not sure who's going to win an election. Okay, it can relate to policy uncertainty. We're not sure what the government is going to do. And uncertainty, and there's a deeper level of uncertainty where we're not even sure what the probabilities are. Okay, so we have no idea what's going to happen. And then expectations. By communication that you see basically when people from the government talk about what they want to do in terms of policy, that influences expectations. When the central bank communicates its policies, that influences expectations. Later on, I'll talk to you about basically meetings, the Federal Reserve's the FOMC meetings, and how people have studied how that impacts stock market prices. Okay. So I want to basically, now I want you to think of this as a very simple, non-quantitative heuristic theory about what determines asset prices. So clearly, if a security gives you more money, it's going to be worth more, cash flow channel. Okay. If the interest rate goes down, okay, that should increase asset prices. Okay. Because you would earn less money in the bank if you put your money there. Then we have the risk channel. If there's more risk, asset prices will go down. We have the uncertainty channel and the expectations channel. Now, which of these channels matter? Now, that's a very interesting question. And this goes back to an argument that economists have been having for a while. So some of you all of you are familiar with Keynes, but then with Keynes, of course, was very influential during the Great Depression afterwards, and I would argue is very influential now. So according to Keynesian Economics, government policy is important, okay? However, after stagflation in the 70s, Keynesian Economics, people came under attack, and we had a new paradigm to think about economics, what we call new classical economics. And in new classical economics, there are actually theorems showing that government policy is irrelevant, okay? So we have this well-known policy irrelevance proposition, which says that if people are rational in their expectations, and if there are no frictions, policy is ineffective. Okay, and a lot of people might not believe this, and the key is the devil is in the details. So for this proposition to be valid, you have to believe that people actually are to some extent rational, and that there are very few frictions in financial markets. And I'll talk about what I mean by frictions. Before I do that, I want to show you a picture of Keynes. Okay, so Keynesian economics, within that framework, Keynesians would believe that short-run management of aggregate demand is possible. So you can actually manage basically consumers' demand and expenditure. Okay, and you can do that in recessions. So what you'd want to do in a recession is think of policies, implement policies which basically increase the spending of households. Okay, so that increases demand. And that's how you basically help the economy, especially in a recession. With new classical economics, the argument is that, well, these policies aren't very good. Okay, and this emerged in the 1970s, and people such as Lucas and Friedman were fundamental in forcing the rethinking of Keynesian economics. Now, I think we've gone beyond new classical economics. Okay, the world gets ahead of economic theory. Okay, so we've had a lot of government intervention despite this new classical theory. Now, why might government intervention matter? So given this policy irrelevance proposition, well, it's a mathematical theorem and it relies on assumptions. When are the assumptions in that theorem not true? Well, they break down, this theorem breaks down when we have what we would call frictions. Now, what are frictions? Well, frictions are basically factors, real life, important real life features of financial markets, which basically means it's harder to share risk, people don't know, people don't all have the same information and so on. A nice example of a friction is the following, okay? One of the assumptions of this frictionless model is that you can basically hedge yourself perfectly against any firm-specific risk, and the only risk you're going to be exposed to is the aggregate economy, okay? Now, it's hard to argue that that's actually true, okay? Most people are not going to be able to insure themselves perfectly against risks in a particular firm by trading in financial markets, and you certainly can't insure yourself against unemployment risk by doing that. Okay, and we call that market incompleteness, and that's a reasonable description of the world. We are all exposed to risks which are not necessarily related to the aggregate economy, which we cannot hedge away. There's also information asymmetry, and it's very natural to think that firm managers would know more about firms than, say, the people outside them. Okay, you would hope that's true in a way, right? It ought to be the case that people running companies know more about them than the people who are not managing them. And I think it's also the case that experts in money management, people whose working day revolves around managing money, so pension funds, insurance funds, and hedge funds, they will have more information about financial markets than ordinary households. That's information asymmetry. And that seems almost obvious, really. And then, of course, there are taxes. We all pay those, and that is an example of a friction. We don't all pay the same taxes either. So because of these real-life frictions, these real-life features of financial markets, government actions can influence the macroeconomy and asset prices. And the world is full of these frictions, okay? So if you think about it, this financial and economic theory almost seems a bit like physics, okay? You start off saying, okay, well, we have Newtonian mechanics, but then if we go to the microscopic level, that doesn't work. So we need a new theory, okay? And here, when you learn physics at high school, you often assume that energy is not lost from a system, but it is because of friction, and that explains why we call these things frictions. So these frictions basically are real-life features of the world which invalidate the standard neoclassical assumptions. And the world is full of these frictions. So I want to talk briefly about policy tools. I'm not sure how easy it is to see this. So governments have lots of policy tools available to them, but they're not always going to implement them. So at the top here, we have monetary policy. So the standard monetary policy tool is the nominal interest rate. And the Bank of England is thinking now about negative interest rates, okay? I've briefly mentioned forward guidance, which is related to the setting of expectations. But since the 2007 crisis, central banks have purchased assets, mainly long-term bonds and corporate debt. But the Bank of Japan has purchased equity, okay? And it remains to be seen whether or not other countries are going to basically buy equity, okay? They're going to extend what QE is to include the stock market. Now, in the response to COVID-19, the Bank of England and others have made loan guarantees and so on, and they're also involved in the direct lending to public authorities, and then there's monetary financing, okay? So the government issues debt and the central bank buys it. Now there is macroprudential policy. So in the UK, the Bank of England said the banks can't pay dividends the way they used to, and capital requirements have been lowered, okay, to make it easier for banks to function, to free up capital. And then there's fiscal policy set directly by the Treasury under orders of politicians. So that could include increased spending on healthcare. There's the furlough policy, so the government says, okay, we'll pay salaries up to a certain level for firms, okay, making loans to companies, taxation, transfers, so you can tax some people more and transfer it to others. So the government has lots of policy tools available to it, and the government is faced with a difficult decision about figuring out which ones to use, okay? Now, for a while, all of this was very unfashionable, precisely because of the policy irrelevance hypothesis. But now, the task of the government is to understand which of these frictions are important and how can you use your understanding of financial frictions to choose wise government policies. So I'm going to show you some examples of government policies and how people have studied them. So I'm going to look at the following four, okay? So we've got fiscal policies and asset prices, and I'm going to show you how that works through a cash flow channel based on US data and work that people have done. I'm going to show you the work that economists has done on understanding how the interest rate channel impacts asset prices. And I'm going to talk about more recent work done on the risk channel, and then I'll talk about the uncertainty channel. So the fiscal policy channel is quite interesting. So basically, if you look at the US stock market data, what you find is that during Democratic presidential terms, firms in industries with high government exposure generally outperform firms in industries with low government exposure by quite a large amount. Okay, so if you are running a hedge fund, this is quite an interesting finding because you can actually try and make money out of it. Okay, so it's quite interesting that basically we have this wide differential between stock market performance, okay, during Democratic presidencies versus Republican presidencies. And I want to first of all tell you what I mean by exposure to government policies. Now, naturally, some industries are more exposed to basically what happens in the government than others. So aircraft and defense. So a major purchaser of aircraft, a major client of Boeing is the US government, okay? A major client of Airbus in Europe is going to be basically governments. Defense, naturally, the defense industry is heavily depends on government spending, okay? So it's kind of obvious. You and I are not in the business of purchasing weapons, okay? Certainly you're not going to purchase a tank. The government can purchase tanks, yes, and fighter aircraft and so on. Large ships, well, the major purchaser of large ships would be a navy. So certain sectors are more dependent on government spending than others. And what this finding by friends of mine, so Federico Bello, Vito Galla, and Jun Lee, is that during Democratic presidential terms, these industries which are more exposed to the government sector, they perform better during Democratic presidential terms. Okay, and here's just a figure taken from their paper, and it shows you both average annual profitability and the excess returns on a particular portfolio. So just imagine that during Democratic presidencies, you want to go long, yeah, aircraft companies, defense industries, and you want to go short, yeah, basically industries which depend less on the government. And that way you can earn basically a differential. You can earn an excess return by doing that. And that excess return is likely to be positive during Democratic presidencies, such as Clinton here, okay? So this portfolio where you go long companies with more exposure to the government and short the ones with less exposure, this will earn you money, okay, on average. So historically, this will have earned you money, and doesn't guarantee it will work in the future, but if you're managing money in a hedge fund, you can bet that this relationship you can bet on it. Take a risk that this relationship will hold going forwards. Now, the other channel I want to talk about, remember I said that the interest rate, that's basically governs the time value of money, and that impacts how we discount future cash flows. And quite naturally then, you would expect that an increase in the short-term interest rate will result in a decline in stock prices. So that's what basic theory will tell us. And the theory is kind of, I think, easy, but actually showing this empirically is much harder. And Roberto Rigobon at MIT and his co-author, Sack, they've shown this in a 2004 paper. Okay, so what the central bank does with the nominal interest rate is important for the stock market valuations. The other work I want to talk to you about is what people have found is that political cycles impact asset price. Now, this is again really very exciting because we used to live in this world where we thought policy was irrelevant, and here now it seems that it's anything but irrelevant. Okay, so if you look at the US stock market data, you'll find that the US stock market rises in response to a Republican victory. Okay, however, the excess return that you earn over investing in treasury bills, yeah, is actually higher when Democrats are in power, and quite a bit higher. So look at the difference between this 10 and this 0.79, about 9% higher per year. Okay, so that's a very interesting finding. Okay, and people have struggled to explain this, but the way people try and understand this is via a risk-based channel. Okay, so we have this interesting finding from Santa Clara and Volkanov, that the excess return in the stock market is higher under Democratic than Republican presidencies, okay, historically. And there is theory trying to explain this, which relies on the idea that maybe you can make the assumption that Democrats are more likely to be risk averse than Republicans. So you can think about Democrats, maybe people more likely to work in the public sector, okay, more risk averse people, entrepreneurs more willing to take risk, they're less like and generally what you find in the data is that Democrats are more likely to be public sector workers, entrepreneurs are more likely to vote Republicans, not in all cases. Maybe the current president is trying to change this relationship, I don't know, okay? And what we find is that when risk aversion is high, what they find is that when the risk aversion is high, Democrats are in power. And when people are more risk averse, they want a higher compensation for taking risk, okay? So there's going to be a higher return on investing in the stock market. There has to be an equilibrium. So if I'm pretty scared of investing in the stock market, what's going to induce me to buy these stocks is a higher return, okay? So when so Pastor and Veronese like this difference in risk aversion channel. So basically a risk-based channel helping us understand why political cycles matter for the stock market. There's another channel I want to talk about, which I find very interesting, which is the uncertainty channel. And I will actually, so Manuel Munch, who's at the Bundesbank, and his colleague Luca, back in 2015, they looked at US equities and they looked at how US equities performed in anticipation of Federal Open Market Committee meetings. So the Federal Reserve has these meetings which are scheduled, so you know when they're going to be, and that's when they make announcements about monetary policy decisions. And what Luca and Munch found is that just before these announcements were made, the US stock market went up, okay, quite a bit, okay. What they found is that most of the return on the stock market above investing in bonds was made in these days before, just prior to the Federal Open Market Committee having its meeting, okay? And people have been struggling to understand this. And there is a nice theoretical way of thinking about it. The idea is that you know that there's going to be a meeting. During that meeting, you're going to get information about the central bank's policy, okay? And that's going to reduce your uncertainty, okay? So so in anticipation of that reduction in uncertainty, the value of the securities which give you these dividends is going to go up, okay? So in anticipation of these meetings, where uncertainty is going to be resolved, asset prices should go up. And there's a nice chart that I've taken here from Munch and Luca's paper. So they basically look at cumulative returns on the S&P 500 around the Federal Open Market Committee announcement meetings. And look at this line here, which is kind of going up. And that's what happens when you have an FOMC meeting. And this is what happens when you don't. So the market is going up around these FOMC announcement days and just prior to them. So based on this, what you would want to do is basically you want to buy stocks before these, and just a few days before these announcement meetings, okay? And then once the announcement is done, sell them. And that way you can earn a good return. Historically, that would have worked. It's another potential way to make money out of this. Now I want to talk about COVID-19. Now what we've seen with COVID-19 is that, well, initially the stock market went down a lot, right? We saw a 30% decline, but since then the stock market performance has been stellar in the US, and we've seen a recovery basically in the US stock market. We are back to pre-COVID-19 levels. In the UK, it's not quite that good. There is additional uncertainty here, perhaps related to Brexit. We've seen a partial recovery in the UK stock market. Now, why is this? So some people would argue that this is just the stock market anticipating the end of lockdown and anticipating that the second wave will not be so bad because we've learned from the first wave. Also, there's been a lot of central bank intervention in markets. The central banks have done a lot of QE. There's been very large scale purchases of corporate bonds, risky debt, okay? And people think that this has changed the way people discount cash flows, okay? And part of the stock market response is just because of government policy. And then we're left with the question, will the stock market recovery fizzle out as government intervention stops, or might it fizzle out because of a second wave? So a lot of market participants are very worried about remaining in the stock market going forward. So, and I know BlackRock have advised clients to be cautious and perhaps take their money out, reduce their stock market exposure, because we're not sure what will happen going forward in terms of government intervention. We don't know how bad a second wave will be. So now I want to talk about some work I've been doing on the UK stock market. So if you look at asset returns, so stock market returns since the 1st of January 2020 in the UK, you can actually try and understand what drives those returns. And you can break those returns down into three components. One component here, which is this line. So look, this is the 1st of Jan. This is basically June, okay? So this kind of blue, I think it's blue, but I'm colorblind. This market is just, this line is just the UK stock market. It's gone down and recovered partially, okay? This other line is very interesting. This line is basically a portfolio which overweights high volatility stocks, okay? And you'll look that this line, this portfolio which overweights high volatility stocks, which I'll call an uncertainty portfolio, has not recovered at all, okay? Yeah. And we can actually look at different sectors of the UK economy and how we can look at how large their exposure is to these different factors. And I want to focus on their exposure to this uncertainty factor, okay? And if you look at that, look at the exposure of different sectors of the UK economy to this uncertainty factor, to look at the different sectors. So we can divide the UK economy up into basic materials, consumer discretionary, consumer staples, energy, financials, healthcare, and so on. And the only sector which has a very large negative loading on this uncertainty factor is healthcare. Okay, so the healthcare sector has actually done better than all the other sectors, not surprisingly, given the nature of the COVID-19 shock. Now, when you look at this heterogeneity in the sectoral response, what you see is that, well, suppose that the economy recovers fully. Well, even though on average the economy looks like it might recover well, the underlying composition of the economy is going to be changed by COVID-19. And we would call that a reallocation shock. So when we're looking at the stock market data, it suggests that people think that there's going to be a lot of reallocation. Okay, so some sectors will recover and even be bigger than before. Some sectors will not recover at all. Okay, there's going to be reallocation. That means in order to get people into employment again, they'll need to move into different sectors of the economy, which is harder to do when you're older. And the government could use fiscal policy at the sectoral level to try and deal with some of these problems. Okay, so now I just want to conclude. So it's clear that asset prices are impacted by government policy. Okay, there are enough frictions out there to break down these irrelevance propositions. What about the future? I think in the future, we can expect more fiscal policy. Okay, so the government's going to think very carefully about its taxation policy. It's going to think about how it's going to direct spending. Okay, I don't think we're going to be in austerity phase for a while. And we can expect even more unconventional monetary policy. For example, central bank purchases of equities. The Bank of Japan has already done this, okay? And it seems to be historically that where Japan goes, we follow. And there's monetary financing, okay? And the Bank of England is claiming this is just temporary, so it's not really monetary financing. We'll see. I think having made that announcement, they will have to pull back on the monetary financing and have to replace it with something else, perhaps negative interest rates. So I think going forward, a good understanding of how government policy impacts asset prices is very important for those who want to make money in financial markets, not to lose it. It's very important for those of us who want to understand the interplay between the macroeconomy and asset prices. So we know that a lot of the government policy is targeted at the macroeconomy, seem to have stronger impacts on the stock market. So how would that impact feed back into the macroeconomy? So that's it. So if there are any questions, I'd be very happy to answer them.
Thank you. So I just had several questions for you. So you mentioned that there could be new instruments appearing for government to interfere with their monetary policies throughout different types of crises. And we had really global events such as a pandemic, global 19th. So, and you mentioned a couple of examples from the Bank of Japan and the Bank of England. So what could be these new types of instruments where government also increases its role through central banks purchasing of equities or monetary financing? What could be that instruments going forward?
Let's start off with purchasing of equity. It looks very similar to QE. Basically, the idea is that the central bank can purchase assets via money. The central bank issues with money, right? So basically says, look, I'm the central bank, I've got the money, you've got some securities. So I'll just give you the money and you give me your securities, okay? And that's how it can purchase equity. And these irrelevance hypotheses say, well, that doesn't do anything, okay? However, if there are frictions, okay, maybe it does, okay? So, and the government may want to do that in particular sectors. Now, the Bank of England has said that it will purchase corporate debt. It will purchase debt issued by companies. And debt at some level is not that different from equity. You know, it's risky. It depends on how well a company is doing, okay? So both debt and equity, corporate debt and equity, are claims to companies' cash flows, okay? The difference with debt, of course, is that you know what the coupon is, but there is a risk of default. With equity, you don't know what the future dividends are going to be. So already the Bank of England is willing to purchase debt issued by universities, for example, in the UK. Yeah. So the idea is that if you purchase a company's corporate debt, you'll reduce its financing costs, okay? Increasing the price and lowering the yield, lowering the credit spread, decrease the financing costs. And I don't think there's any reason to think why that wouldn't work with equities, but the Bank of England is going to be very worried about distributional effects. So what you generally find is that wealthier people are more exposed to the stock market. And it's difficult for a central bank to undertake a policy which benefits the wealthy disproportionately because they hold more, they hold more stocks.
And what new instruments could be to facilitate more efficient policies on the side of the government? Out of different economies, we have developed economies, emerging economies, and different political regimes. So you mentioned Democrats and Republicans in the U.S. So how to make it more balanced? What are the instruments?
Okay, so what governments can do is basically, in the US, you've seen the government's just given people money. Okay, you can give people money. Just write a check to them. Okay, that's one thing you can do. Another thing you can do is basically reduce taxation. So certain taxes we all pay when we purchase things, so value-added taxes. So you could reduce value-added taxes. The government is talking about that right now in the UK. Yeah? So the taxation policy is very complex, okay? So that means that there's lots of scope for the government to do things. But because it's complex, it's hard to understand what the effects will be. And the government has to the difficulty for the government is that policies will not have the same effects on everyone. Some policies will help the rich more than the poor. Some policies will help the poor more than the rich, okay? So that's where politically it becomes very difficult.
What do you think on the new tech instruments such as blockchain interfering into different types of instruments such as voting and other types to make more transparent all the governmental kind of influence? What do you think about that?
So I think
the role?
Blockchain. So let's focus on the cryptocurrency aspect, because blockchain enables that. In countries where the actual local currency has not been that stable, then I think there's room basically for cryptocurrency to become more important. Okay, it's a better store of value. Okay, I think it's hard for a cryptocurrency to displace the US dollar or the euro, but there are countries where inflation has been rampant. Okay, the real value of your money is very unstable, so cryptocurrencies could be important there. I think what you'll see going forward, I think you're going to find that in the richer countries, central banks are going to issue their own digital currency.
And what do you think on the future of these digital currencies? How global or local they will be distributed, and what would be the role of this instrument in general?
The digital currencies issued by central banks, that I would anticipate eventually that will be what everyone will use. Okay? And then in countries which have a currency which is not stable, you could find it interesting if a cryptocurrency which is private, okay, if basically a non-government issued cryptocurrency is able to show that it's a stable store of value, it could actually displace the government currency. Okay, that would mean the government would lose that monetary policy lever. Okay.
And what would be the role of decentralized instruments in various spheres? So we see decentralization in technologies in terms of cybersecurity and all this type, and we also have decentralized models for digital currencies. So what should be the role of government controls and decentralization in general?
So again, I think that depends very heavily on whether you're in one of the richer OECD countries or kind of a developing country. So I think I can't imagine that the Federal Reserve allowing a private kind of currency to displace the dollar. Okay? I think that's highly unlikely. I think competitive effects could be useful in in countries with less stable currencies. So if people, it's quite nice. So you have competition. So if you have many currencies issued, digital currencies, that can provide competition for the government currency. So the government is forced then to basically pursue policies which reduce inflation. And then going forward, I think in terms of the world, if you believe that if you want to own assets which are less influenced by government policies, then there is scope for cryptocurrencies to grow. Okay, there's a question basically on whether households want to hold currencies which are less influenced by the government policies. Okay.
Mm-hmm. And what would be your recommendation to our audiences, which are majorly serial entrepreneurs, startup leaders, and VC investors in the current post-COVID or between the first and the second wave, and the global crisis actually we are all in?
Well, from an investment perspective, I think digitalization is going to become much more rapid. Okay, so now we're all used to working on Zoom. Okay, digital has become the new normal for all kinds of human interactions that previously took place face to face. Okay, like in January, I was in Davos, giving a talk live. The mountains were real. Okay, now I'm doing it at home with a fake background. And education. Okay, so all families, are basically seeing that their kids are learning online. Okay, and so people are used to it, right? They're used to online learning now. So edtech is going to be a huge thing. Okay? So I think you're going to find probably people like me going into edtech. And I think for venture capitalists, that's very interesting, the edtech space.
Do you work with startup companies yourself or investors currently advising on different fields? With their
I'm a co-founder and advisor at AdviceGrid, which is a wealth management company focusing on the pension space here in the UK. And what we have is, I think, very nice technology which allows you to optimize on a taxation basis. So it's one thing to have a portfolio which is well optimized, but given that it's very difficult to estimate expected returns, it's not clear how strong the gains will be, but we have much more certainty about what taxes are, okay? And it's actually quite hard mathematically to figure out the optimization problem for where should you put your money when you're investing for your pension and your retirement. And we have nice technology. We're using machine learning, which allows us to figure out that optimization problem. And I think it would be quite useful for everyday people who do not have the time to think about these things themselves. And all they have to do is supply information about their investments, their pension, and so on. And then you can actually tell them, okay, if you rejig things in a certain way, you can earn, quite large amounts over periods of 20 years relative to what you're doing now.
And what is the most recurrent question you get from your clients nowadays?
So I think that the most important question really is basically, so when you're talking with businesses, they want to understand not just how the people working for them will benefit, but how will the business benefit. So they can see that their employees will benefit from this, but how's it going to impact the business and its cash flows?
Okay, so what would be your final address to our audiences before we close the event? So what would be your key advice and a word to go?
What would I say? So I guess given that I've been talking about asset prices and government policies, I guess if this is your full-time job, okay, managing money, I think then, yeah, I think it makes a lot of sense to actually read some of the papers I've referenced. At the end here, I actually have the references. If you were to do this on the side, on top of your day job, is difficult, okay? So the best advice I would give people is not to panic if the market goes down, unless you're very close to retirement, okay? If you're 10 years away from retirement, I would just keep your exposure to the stock market. Don't worry about which individual firms to buy. Just buy broad-based ETFs. Okay. For people who are working on in the VC space, focus on your VC investments. Okay. Don't spend a lot of time rejigging your your private portfolio in the stock market, because what we find is that unless you're a professional, a lot of the rebalancing you do goes wrong. So what a lot of people will have done after the stock market crashed in March is withdrawn from stock, taken money out of the stock market. And then when the stock market goes up, their money's out. So the losses they've made are going to be around for much longer. Okay. The big takeaway, I would say, the biggest takeaway is that asset prices are forward looking. They react to what's going to happen in the future. They don't react to what's already happened.
Thank you so much, Harjoat, and we wish you all the productive week. And please join our different types of events, such as roadshows, pitch competitions, Startup Leaders Club, fireside chats, keynotes, and masterclasses. And in around half an hour, we'll go to our Startup Leaders Club, devoted to disrupting industries, creating new business models, and finding new opportunities in crisis. And today we'll be discussing trends, challenges, and opportunities for tech startups. So we welcome you also to join different types of these events. And thank you so much for your nice and in-depth presentation today. And I hope you get new clients also from our VC community. And we wish you all the best. Bye-bye. Thank you.
Thank you very much, Nadia. It was a pleasure.